Silver vaults in London and New York are hemorrhaging inventory, down 40% in 3 years, from over 1.2 billion ounces to under 750 million, while the paper price lingers at $30 an ounce. Yet physical premiums in Shanghai spike 20% above spot, and industrial buyers scramble for bars that simply aren't there. This isn't a glitch, it's rupture. The system that priced silver as abundant is fracturing under hoarding that starves the West. Refiners halt shipments without warning, quotas tighten overnight, and the flow reverses. Metal pours east, never to return. We're not approaching a squeeze, it's already locked in. Look at the signals stacking up. COMEX deliveries hit record lows last quarter, with eligible stocks barely covering open interest. Institutions aren't waiting, they are pulling physical off exchange, converting futures to bars before settlement fails. This behavior screams loss of control. When banks like JP Morgan quietly amass their own stockpiles, it's not investment, it's self-preservation. The logic breaks here because in a stable market, arbitrage would equalize these disparities. But arbitrage requires movement, and movement is being choked off at the source. Export licenses and key producers vanish, turning global trade into isolated pools where price discovery dies. This echoes the gallium shutdown of 2023, where China didn't declare war. They just required special licenses for exports, and shipments dropped to zero. Prices doubled in weeks, crippling Western semiconductor lines. Silver follows the same playbook, but amplified. It's not niche, it's embedded in every circuit, every panel, every weapon system. China processes 40 to 50% of global silver concentrate, even if the ore comes from Mexico or Peru. That concentrate crosses the Pacific, gets refined in Shandong smelters, and stays. No re-export. The West's assumption that friendly miners in the Americas secure supply? Illusion. The metal isn't ours until it's purified, and purification is now a geopolitical lever. Consider the historical mirror. In 2010, over a minor fishing dispute, China curbed rare earth exports to Japan. Prices surged 2,000%, exposing how dependent tech giants like Toyota were on unchecked flows. Back then, it worked, because the West could pivot, scramble for alternatives, ramp up recycling. Now, with silver, pivoting isn't an option. Building new smelters takes 5 years minimum, billions in capital, and navigates regulatory mazes that prioritize green mandates over industrial revival. We've regulated away our own capacity. EPA rules shuttered US facilities like ASARCO and El Paso, while China subsidized the pollution we outsourced. This isn't progress, it's dependency engineered into vulnerability. The fracture widens in the solar sector, where demand isn't elastic, it's existential. China's solar industry alone devoured nearly 200 million ounces in 2023, 25% of global mine output. And that's before the pivot to TOPCon panels, which consume 20 to 50% more silver per unit for higher efficiency. They install more capacity annually than the US has cumulatively. If you're tracking solar deployments, you've seen the targets for 2025, staggering, unyielding. But here's the inversion. Instead of exporting raw silver at $30 an ounce, China keeps it to fabricate panels sold back to Europe at premiums that lock in dominance. This dual pricing emerges, cheap inside their borders for manufacturers, unobtainable outside. Western firms like First Solar in Ohio face input costs ballooning, subsidies from the Inflation Reduction Act evaporating in real terms. If you've followed commodity flows or work in renewables, how does this dual market look from your vantage? Share your observations in the comments. Does it align with what you're seeing in procurement chains, or is there a counter-signal I'm missing? The system's loss of equilibrium shows in the silence from regulators. The CFTC and SEC issue no warnings on vault drains, no probes into premium divergences. Media glosses over it, fixating on equities while physical markets signal alarm. This omission isn't oversight, it's complicity in a narrative that sustains the paper illusion. In a healthy system, such gaps trigger interventions, margin hikes, position limits. Here, nothing. It suggests the breakage is too systemic to acknowledge without panic. We've seen this before in the oil embargoes of the 1970s, where OPEC's coordination didn't start with bans, but with quiet quota adjustments that rippled into crises. Silver's producers, Mexico, Peru, Chile, hold similar concentration, outpacing oil's fragmentation. Resource nationalism isn't coming, it's active. Mexico's state-run lithium push in 2023? Precursor. Now, whispers of silver reclassification as strategic echo China's move. Governments eye windfall taxes. If prices hit $80, with production costs at $20, a 75% levy on excess profits captures the upside for the state. Miners in Latin America face permit delays, environmental hurdles that smell of expropriation. This isn't random, it's retaliation in a decoupling world. The US restricts chips to China. China counters with metals. Mexico, squeezed between, leverages its ore. A silver OPEC forms not through cartels, but aligned policies. Unified export taxes, domestic refining mandates. The floor price lifts from geological costs to political ones. $50 minimum, baked in. History as mirror reveals why this fractures now. Post-World War II, the West treated commodities as infinite inputs, financializing them via futures while offshoring the mess. We built apps, they built infrastructure. The 1940s US oil strategy: secure resources to fuel industry. China mirrors today, but with silver as the new oil for green tech. Unlike then, when abundance masked risks, today's mineral-intensive shift exposes the scarcity. You can't electrify without atoms, and atoms are contested. The green transition, meant to deflate energy costs, inflates them as inputs hoard. Geopolitics interlaces with logistics here. Bulk carriers laden with Mexican concentrate dock in Chinese ports, but outbound refined bars stall. Supply chains, once just-in-time, fracture into just-in-case stockpiles. Military angles sharpen the edge, silver in guidance chips, radar, missiles. The Pentagon's gallium scramble was a rehearsal. Silver denial could hold production lines for F-35s or hypersonics. No shots fired, but the economy grinds down. This isn't escalation, it's the quiet phase where control slips away. For those in defense or tech sectors, what inconsistencies have you noted in material sourcing lately? If silver access is tightening on your end, detail it in the comments. Your input could clarify where the bottlenecks are hitting hardest. The behavioral shift among large players underscores the trap. Tesla, Samsung bypass open markets, locking direct offtake from mines. This drains liquidity from comics, where leverage amplifies fragility. 20-to-1 ratios mean small delivery demands cascade into squeezes. Paper shorts, once safe bets, face physical calls they can't meet. The 1980 Hunt Brothers episode? Amateur hour compared to the state-orchestrated version. Back then, it was speculation. Now, it's survival. Shanghai's gold exchange, delivery-based, emerges as the true arbiter, premium signaling the real price, while Western spots lag in denial. This where the logic snaps. A market priced on trust, but trust erodes as flows halt. BRICS de-dollarization adds monetary torque. Silver as neutral asset, hoarded against fiat weaponization. Central banks stock gold. Populations in India, China grab silver. It's the intersection. Industrial voracity meets monetary refuge. Prices delink regionally. $100 in the shadow market, suppressed officially. Coin shops quote premiums. ETFs declare force majeure. If you're an investor tracking BRICS moves or holding physical, how do you interpret this monetary layer? Weigh in below with your take. Does it accelerate the split, or is there a stabilizing factor overlooked? Industry bleeds into military. 5G chips, solid-state batteries demand silver irreplaceably. Samsung's silver carbon anode isn't optional. It's the efficiency leap that locks in demand inelasticity. No substitute scale. China's 70% battery dominance, fortified by keeping metal internal. The West's EV push stalls as costs soar. Green agendas invert from deflationary to inflationary. Policymakers assume perpetual abundance. Reality asserts limits. Logistics reveals the panic. Procurement managers double orders, suppliers cite quotas. 3-week inventories evaporate. This commercial desperation, not retail frenzy, ignites the squeeze. Vaults empty not from coins, but structural redirection. Eastward. Permanent. Historical parallels tighten the noose. Britain's mercantilist wool bunds in the 1700s staffed competitors to build empire. China replicates, but with solar as the empire. They sacrifice raw export profits for manufactured dominance, panels over bars. Dual circulation, self-reliant inside, dependent outside. For supply chain pros or those in manufacturing, what's your read on these procurement shifts? If you're seeing order surges or denials, describe them in the comments. It builds the picture of how widespread the strain is. The crash isn't price collapse. It's systemic implosion where access trumps cost. At $100, if none available, it's infinite. Western miners in safe jurisdictions, Nevada, Australia, gain premium. Latin ones discount for risk. Governments rewrite codes, tearing contracts. Greed universal. States as hedge funds. This isn't where it stabilizes. The phase is mid-rupture. Vaults drain further, premiums widen, silent regulators watch denial crumble. No recovery to abundance. The trap snaps shut on those holding paper. If you've analyzed similar historical resource shifts like the 1970s oil, how does silver's trajectory compare in your view? Share your parallels or divergences in the comments. Collective insight sharpens the analysis. The final signal. Media's focus elsewhere. Tariffs, stocks, while this war rages in shadows. It's not ignorance, it's avoidance of the uncontrollable. The system, once fluid, calcifies into blocks. Americas with ore, Asia with process, West with needs unmet. Control lost, the process advances unchecked. For those monitoring media or policy signals, what does this selective silence suggest to you? Post your interpretation below. Does it confirm complicity or point to something else brewing? COMEX registered silver stands at under 35 million ounces, barely enough for 7,000 contracts, while open interest exceeds 150,000. In the first 4 days of December alone, over 47 million ounces were claimed for delivery, draining more than 60% of available stock in a single settlement cycle. This isn't withdrawal, it's evacuation. Shanghai inventories deep below 446 tons, the lowest since 2016, as metal flowed west only to reverse under tariff fears, then stalled again. Lease rates spiked past 40% before collapsing on forced liquidity, exposing how thin the physical layer has become. The paper price hovers near $62 after touching $64.65, but physical premiums scream shortage. Buyers pay whatever it takes because the alternative is halted production lines. The rupture accelerates precisely where the system was designed to flex. For decades, Western markets assumed infinite arbitrage. Ship concentrate to Chinese smelters, refine, re-export bars to London or New York. That loop held because China needed dollars from finished goods more than it needed the metal internally. Now the calculus inverts. With TOPCon dominance exceeding 85% of production, each panel consumes 20 to 50% more silver than the PERC era, pushing China's solar sector toward 300 million ounces annually if installations hit targets. Beijing's response isn't proclamation, it's implementation. State trading licenses for silver exports, effective cycles tightening outflows, framed as resource protection, but functioning as retention. Concentrate arrives from Mexico and Peru. Refined bars stay. The Roach Motel logic hardens. Entry permitted, exit restricted. Historical precedent clarifies the shift. The gallium and germanium controls of 2023 didn't bend trade. They required licenses, and exports fell to zero. Prices doubled overnight, defense contractors scrambled, no domestic fallback existed. Silver replicates the pattern at scale. Not niche defense, but foundational to electrification. China's refining grip, processing 40 to 50% of global concentrate even without primary dominance, turns smelters into gates. No new capacity emerges quickly. Western environmental rules that shuttered facilities like ASARCO now block revival. 5 to 10 years for permits, billions in capital, inconsistent grid power. The timeline mismatches the demand surge happening now. Producers awaken to their leverage. Mexico's reforms push higher royalties and state involvement. Peru weighs tax regime shifts amid protests. Latin America's share, over half global primary supply, faces political repricing. If windfall levies capture upside above $30, the effective cost floor rises to $50 or higher. Mines don't close immediately, but expansion stalls. Juniors discount jurisdiction risk. North American deposits gain premium not from geology alone, but policy stability. The concentration mirrors oil's 1970s vulnerability, but silver's byproduct nature, 70% from base metal operations, limits responsive supply. No spare capacity idles waiting for signals. If you're in mining finance or tracking jurisdictional flows, how are these reforms altering project valuations on your end? Detail the shifts you've observed in comments. Does the discount on Latin assets already reflect this, or is the lag creating mispricing? The solar motive sharpens the choke. China's installations alone outpace cumulative US totals. Subsidized factories churning modules for export, while internal silver prices decouple downward. Western competitors, subsidized under Inflation Reduction Act plants in Ohio, Georgia, face exploding input costs if global availability tightens. The strategy isn't hoarding for wealth, it's securing atoms to dominate manufactured value. Export raw at $60, minimal jobs, erodible margins. Embedded panels sold at premium, millions employed, monopoly entrenched. Dual circulation formalized, self-reliant core, dependent periphery. Battery layers compound the pressure. Samsung's silver carbon anode prototypes, oxide electrolyte, thinner designs, push energy density boundaries, but each advancement locks in silver dependency. Scale to 20% EV adoption and annual demand jumps tens of millions ounces, inelastic because substitutes lag. No pivot exists at volume, chemistry dictates the metal. Military echoes amplify quietly. Guidance systems, radar, optics, silver's conductivity replaceable on high-performance nodes. The gallium warning shot rehearsed denial. Silver escalates to economy-wide stall. No missiles, just license delays, and lines hold. For those sourcing in electronics or defense, what delays or premium spikes have emerged in new chains this quarter? Share specifics and comments. Patterns across sectors reveal where the strain concentrates. Pricing mechanisms fracture under the weight. COMEX and LBMA designed for abundance, leverage, cash settlement, trust and delivery. When physical flows halt, trust evaporates. December's vault rate wasn't speculation, it was industrial cover. Institutions pulling before settlement risk materialized. Shanghai premiums persist, not as anomaly, but revelation. The real discovery, shifting east where consumption resides. Western spots lack in paper denial, backwardation signaling the split. The silence from oversight bodies, no wall drain alerts, no position probes, marks the phase. In stable systems, anomalies trigger response. Here, acknowledgement risks cascade. Media pivots to equities, tariffs, while this contest unfolds in permits and quotas. If you've tracked similar decoupling in other commodities, like rare earth, how does silver's trajectory align or diverge? Post your comparisons below. Historical mirrors clarify the endpoint. The process advances mid-cycle. Deficits compound fifth year running. Inventories at decade lows. Nationalism embedding higher floors. No return to $20 abundance. Geological walls, political taxes, technological locks converge. Access eclipses price. $100 affordable means nothing if bars unavailable. The gates narrow, control slips further. The rupture embeds deeper into the structure itself. For procurement or policy watchers, what does the regulatory quiet signal in your view? Interpret it in comments. Complicity, paralysis, or preparation for something larger. COMEX registered silver collapses below 40 million ounces mid-December, with over 47 million claimed in the opening days alone. More than the entire deliverable stock at November's close. Shanghai warehouses scrape decade lows under 450 tons, backwardation locking in as near-term contracts trade 5% above forwards. Spot breaches $63 before retreating, yet physical bars vanish at any price. Lease rates top 100% annualized in isolated pockets. Premiums in India and Europe spike 20 to 30% over paper quotes. This isn't correction. It's confirmation. The gates have closed. The metal trapped east. The Western pricing edifice hollowed out. The inversion completes where the system once balanced.
For years, Chinese refiners absorbed Latin American concentrate, purified it, re-exported bars to fill London and New York vaults. That arbitrage sustained the illusion of abundance. Now, Beijing's state trading licenses for 2026 to 2027, announced late 2025, require performance thresholds only insiders meet, effectively capping outflows. Exports surged briefly in October to relieve London squeezes, then halt. Concentrate still arrives, refined silver stays. The toll booth slams shut, not with bans, but bureaucracy calibrated to retain. Producers align in response. Mexico's mining reforms, higher royalties, state participation mandates, embed as law, while Peru's tax reviews target windfall capture above $40. Latin output, over half global primary supply, faces political friction. Concessions shortened, environmental hurdles weaponized. This isn't ideology, it's arithmetic. At $60 plus, production costs $20, the excess becomes sovereign claim. Effective floor lifts to $50, expansions freeze, juniors re-rate downward. Safe jurisdictions, Nevada, Ontario, absorb capital flight, but volume lags years behind. If you're evaluating mining exposure or jurisdictional shifts, how do these reforms weigh in your models? Share the adjustments you've made in comments. Does the Latin discount now fully price in the nationalism? Or is there still lag exposing opportunity? Solar demand crystallizes the lock-in. China's installations alone eclipse prior global records. TOPCon saturation, pushing per panel consumption 30 to 50% higher. The sector devours projections. 261 million ounces globally in 2025, with China's share driving internal retention. Panels export, raw silver does not. Western factories, subsidized in Arizona, Georgia, bid against ghosts, inputs inflating as availability fragments. The green transition, sold as deflationary, reveals its mineral toll. Costs rise where atoms scarce. Battery and electronics layers seal the inelasticity. EVs embed 40 to 50 grams each, semiconductors irreplaceable nodes. No scalable substitute emerges. Thrifting slows against volume. Deficits compound, fifth year, 149 million ounces projected shortfall. Vaults drawn, not replenished. For those in solar procurement or EV supply, what inventory buffers are you carrying now versus pre-2025? Detail the changes in comments. Patterns across firms map the real strain depth. Pricing delinks irreversibly. COMEX and LBMA, built on leverage and cash settlement, confront physical calls they evade. December's delivery rate, 60% registered claimed, signals institutions front-running failure. Shanghai's delivery mandate asserts truth. Premiums there weren't anomalies. Western discounts were. As flows cease, regional markets calcify. $80 shadow, $50 official possible. ETFs face audits, force majeure whispers. Monetary talk accelerates the split. BRICS settlement bypasses dollars. Silver, neutral, flows to reserves alongside gold. Populations hoard where fiat weaponized. Intersection complete. Industrial necessity meets refuge demand. If tracking de-dollarization flows or physical holdings, how does silver's role evolve in your assessment? Post your observations below. Does the monetary premium now dominate industrial or balance shifting further? The face embeds terminal. Regulators silent as vaults echo. Media pivots elsewhere. No reversal to fluidity. Blocks harden. Asia processes. Americas extract taxed. West consumes rationed. Access defines value, not ticker. The rapture, mid-2025, evident in drains and premiums, consummates. Control transferred, abundance myth buried, the process irreversible, without systemic concession, no way in sight. For analysts mirroring against rare earth or gallium precedents, where does silver diverge in resolution timeline? Interpret the parallels in comments. Does the scale force faster accommodation or prolong the fracture? Silence from oversight marks endpoint proximity. In stable orders, disparities provoke action. Here, inaction admits uncontrollability. The war, fought in licenses and quotas, concludes not with reversal, but reconfiguration. Atoms east, promises west. If monitoring policy or media omissions, what endpoint does this quiet project for you? Share the read in comments.
preparation for managed decline, or something sharper ahead.